Commentary coming in from India Inc., the top guys in Delhi right now interacting with the government, giving them feedback. What would it take to get back the animal spirits? What would it take for India Inc. to claw back out into the growth area, because there is clearly slowdown in many sectors. Aishvarya Dadheech, fund manager at Ambit, is here with me to talk about markets and things at large. Aishwarya, looking at the way markets are panning out today, clearly there has been some revival of sentiment on the street. Value buying, short covering seem to be emerging. Do you think one can make a case that probably in the interim a base is made in the market?
Thank you so much for having me here. It's a cheerful day. Yeah, somehow I believe if we look at the way things went wrong in the market in the month of July, primarily because of the policies announced in budget, especially on the tax incidents, and we saw a big drawdown in the equity market. But now the talks are around that there might be some reversal, and that's why we are seeing this kind of a recovery happening. But one of the most important things which I also want to mention here is, so if you look at this quarter so far, the expectations after the very muted quarter 4 was very low for this quarter itself. Though there is a slowdown, that is evident, right? But if you look at the consumption sector, which is a real indicator of economy, what we have seen is that there has been quite a good resilience in the performance of all those consumer staples as well as consumer discretionary, likes of Nestle, HUL, even home buildings like Asian Paints, Astral, Supreme, Kajari have seen decent volume growth. Dabur reported 10% volume growth on base of 21% growth. So the consumer discretionary segment has been discretionary as well as the staple segment has remained quite upbeat. Even if you look at the other sectors, bank have reported decent numbers, though there is a slight commentary where on the asset quality there might be some issues there, but so far things look good. Cement reported good numbers, though it's more led by realizations. But the point I'm trying to make here is that the quarter has not been washed out. So it clearly shows that things might not be that doomed as what the market is perceiving. And that's why even today's market is like reflecting whenever
Let me play the devil's advocate, Aishwarya. Sure, you are right in your observation, but there's one large company, the leader in the innerwear segment. It is also seen, I don't want a reaction on the stock, but I want to understand that is seen as an indicator of the consumption segment. And this time there was a negative growth coming in. And we have seen Van Heusen and many others, the smaller players also, and other players also jump into this high margin premium innerwear segment. What's your take there? How do you analyze the commentary? Don't react on the stock price, but is there signs of slowdown emerging at the horizon?
So see, there is definitely some signs of slowdown which is visible, but I think the situation got aggravated more primarily because of the kind of capital liquidity issues is happening. So the distributors are not able to rotate the capital, and things are more or less stuck at that level, which is also impacting the growth in a bigger way. Even our interaction with the management of all these companies you are mentioning about are finding it they're finding that distributors are at their level not able to find to rotate capital, and which is visible in the growth side. What we believe is that though there is improvement in the liquidity scenario in the last 2-3 months post-May, we are at surplus liquidity now, but the transmission of liquidity and the rate at the ground level is not picking up. So I think some announcement which will give confidence into the system where the money start flowing through, we believe this growth will start reflecting in a better way.
In fact, your point you made about the transmission at a ground level today as well, there is commentary coming in from NBFC that JP Ramal just said that there's enough liquidity in the system, transmission is not happening. There was special mention about transmission from RBI governor in the policy as well. So it appears that now the focus is coming on, and today the way NBFC stocks are gaining, there seem to be some amount of sentiment change on valuation that at least get into the moment transmission is available, then these stocks will not be available at that price. So what's your view on NBFC?
And one more thing, right? If you look at the historical last, say, 2 decades, whenever there is a rate cut happen, transmission normally happens immediately in the debt market, right? But if you look at the corporate bonds and if you look at the actual cut in the rate, that ranges anywhere between 20 to 50%. You see historically 5-6 instances that has happened. So I believe transmission will take more time to get reflected into the system. But on the NBFC side, we believe that this is an opportune time to invest into like good and clean NBFCs where you have a lot of comfort on the liability franchise. See, on the asset side, growth is never a concern because we are a capital-starved country, right? But someone who is able to manage his ALM well, someone who is able to have a very strong liability franchise, who has adequate equity to that kind of growth, and which has a very clean corporate governance. These are the time to get into those kind of NBFCs.
Aishwarya, stay with us. I'll come back to you, but my colleague also caught up or has some of Ambit. Aishwarya, I want your view on auto and auto ancillary ecosystem. We spoke about NBFCs. But this is also an area which has seen maximum damage. You talk of the name Bharat Forge, Motherson, Maruti, entire ecosystem auto ancillary has been really cut into half because of disruption and BS6 and all of that, and some changes in the policy level, fears of that. But do you think some of them have started to show some value now? How should one approach this entire space, or should we look at it by the same paint, the same brush, all of them?
No, we are of a view that there have been slew of events which has impacted auto, right from higher cost on insurance, on BS5, on security, on registration recently. But the bigger hit was because of this liquidity crisis. So basically, in auto sector, autos are not sold. It's finance which is sold, right? So we believe that in the next 6 to 9 months, we will see some recovery coming back to in the financial system, and that will be the time we will start see recovery in the auto sector as well. Probably after the Diwali, we might start, because the whole thing will get anniversarized and will start reflecting its volumes. On the valuation side, what we believe that this is the time to actually identify those market leaders who have been there for long, and the intensity for those businesses will continue to go ahead as our per capita income will grow in India. So we are like nowhere there. So we are very upbeat that these are the actual time to start getting into quality OEM names.
Passenger vehicles?
Probably passenger vehicles, like the leader in the passenger vehicles, even the leader in the two-wheelers. But I think PV will be the one which will take the rebound faster. CV might take some more time because it is also deployed dependent on the economic scenario. But we are very upbeat on PV and to some extent to the leaders on the two-wheeler side. On auto Inc., I think believe that the OEM recovery will happen first, and then we will see some recovery happening on the auto Inc. But very, very upbeat on this valuations because those are the balance sheet with huge amount of cash, good companies, market leaders. I think this is the right time.
In fact, market leaders are trading very strongly in traders as well today. All right, Dadheech, we'll let you go on that one. Thank you so much for dropping by today.
Thank you.
That was Aishwarya Dadheech.